Let's talk about finance within a business organization. Here we have an organizational chart, presumably of a corporation. We see that we have the board of directors, a chief executive officer, and then chief operating officers, chief financial officer, and various departments underneath. But I think that we need to alter this organizational chart and add on top of the board of directors another box. And that box should read the common stockholders, because within a corporation, the common stockholders are the owners of that corporation. And that's who everyone should answer to. And we'll figure out why in a minute. The common stockholders then have voting privileges, and they elect members to the board of directors. So what do the board of directors do, and who's it made up of? Well, the board of directors is responsible for crafting the firm's corporate policy. Who makes up the board of directors? Well, most of the time, the board of directors is made up of the major stockholders in a corporation, because they have a vested interest in what goes on in that corporation. So if someone owns a lot of stock, they're certainly going to want to preserve their self-interest and vote for themselves. So the board of directors is usually made up of the major stockholders in a corporation. Below them, we then have the chief executive officer. That chief executive officer is responsible for carrying out the policy that's been crafted by the board of directors. The chief executive officer is a manager, and the CEO is hired by the board of directors to carry out that policy. So you might want to draw a line, even if it's a mental line, between the board of directors and the chief executive officer. So everyone above that line is an owner in that firm. Everyone below that line is an employee or a manager. They are hired to do a job. So what is the goal of financial management? We saw in our previous slide that the CFO had a pretty important position, reported directly to the CEO. Well, the primary financial goal of management, and that is everyone that's below that imaginary line that I had you draw. The primary financial goal is to maximize shareholder wealth, and that translates to maximizing the stock price. That's making decisions that maximize the firm's stock price. Oftentimes people will think that the goal of management is to maximize a firm's earnings or to maximize its income. That really is not the case. That would be incorrect, because profits, earnings, income, that is an accounting term, whereas stock price is affected by something we call cash flow. And in this class, we're going to learn a lot about cash flow. We're going to learn in subsequent chapters that the value of any asset is equal to the present value of that asset's future cash flows. So stock price is affected by cash flow. So we want to make sure that everyone that is a decision maker, a manager in that firm, that they are making decisions, good decisions, that affect cash flow, the firm's cash flow, because it is that affects the stock price. Most decisions, most significant decisions, are evaluated in a firm in terms of their financial consequences. Now, I might be a little biased, but I think that all business decisions in a firm are rooted in finance. Stock prices change over time as conditions change and as investors obtain new information about a company's prospects. So let's review. Managers must make decisions that maximize the firm's stock price over the long run. And a firm's stock prices are based on the firm's cash flows. Managers must consider the timing, the size, and the riskiness of future cash flows. Accounting terms such as earnings, profits, income totally ignore cash flows. It is cash flows that affect stock price. So managers have to make decisions, good decisions, that maximize the firm's stock price over the long run. So that means they have to make decisions, good decisions that affect the firm's cash flows over the long run. Stock prices and intrinsic value. Well, in equilibrium, a stock's price should equal its true, or what's termed its intrinsic value. And intrinsic value is a long-run concept. So if investor perceptions are wrong, a stock's price in the short run might deviate from its intrinsic value, but managers should avoid actions that reduce intrinsic value, even if it might increase stock prices in the short run. In other words, making decisions that might cause a spike. We're going for the long term, making decisions that make the stock price increase over the long run. So the goal of managers is to maximize the firm's stock price over the long haul, and that's its intrinsic value.